Okay, I guess we'll start for now. Anyone can join in middle. Hey everyone. Welcome to another session by yours truly. So first of all, I'm going to be starting with what you guys want me to start from. So we're going to get into the most difficult topic first. Based on majority vote, most of you told me that the most difficult topic was finance, motivation, and marketing. What you guys? Dante, there's like current assets can be your salaries, your office supplies. Yes, let me go over it again. So your current assets are assets which last only under a year to the business. So this is like your office supplies, if you have like food items for your business. This can be your petrol for your cars and your machinery, anything that lasts under a year, while your non-current assets or your fixed assets are assets which last you more than a year. So this is your machinery, which you're going to be using for a long time, your warehouses, your cars. Some of your employees can also be considered as your long-term or non-current assets, since they're not going to leave within the year, right? Okay, that's good. So moving on to sources of finance, we're going to go over internal finance and that stuff. So you have your retained profit, which is similar to revenue. It's after you have like calculated all of your expenses, and yes, I will send you all the notes after this. I just Googled them last minute, honestly. You have retained profit, which is like after you have gotten all of your expenses out of your gross profit, and the profit you have left over, that's your surplus. You're gonna be reinvesting it back into the business. And the benefits of this is that it does not need to be repaid because it's literally just your earning, the surplus of your earnings. And there's no interest, no nothing you need to you don't owe anyone anything. It's like entirely your own to use. However, newer businesses or businesses which aren't really hitting their break-even points yet and are really new to the firm with low sales, they're not going to be able to get a lot of retained profits, so they still need to rely on a lot of extra external sources of finance, right? And even for large businesses, retained profits may not be like large enough to reinvest into the business on their own. They need to be paired with other sources of finance. Also, by keeping more profits as capital, like within the business, reinvesting them, your shareholders may not approve of this, especially if you're in a large company with a lot of co-owners. They're going to demand more profit shares for their own personal gain, and either accounting economic session. I don't take either accounting or economics, but I'll see what I can do. You can ping some of the helpers in those subjects. Anyways, where was I? Yeah, so basically, if you have a lot of shareholders, they're going to demand more profits. So either you give the profits to them and, lower your overall usable retained profits that you can use, or you risk, making them upset. And this in turn can cause a lot of conflicts within the business. Let me send you all the notes right now. The chat's distracting. Okay, do let me know if you got it. Okay, anyways. Yes, we're gonna go over a past paper after I go over the syllabus, if we have more time. The session might be 2 hours long, but I'm going to try to wrap up at least the syllabus part in under an hour. So the next hour we have is for questions, past papers, and everything else. Lord, the lag is insane. difference between current assets and current liabilities is basically current assets are like retained in the business for just like under a year, while non-current assets are basically just like you can use them for over a year. It's like machineries versus your stationery. Like a pen runs out within a year, but if you have like an ink machine, it won't, I think. Okay, anything else? A question? Or should I carry on? Do ping me for your questions because sometimes I get lost in speaking. I don't really see chat. Redundancy basically refers to when a company has a surplus of employees and they basically need to cut down some employees, not because they're bad, but they don't need them anymore. Hence, the employees are made redundant. I'm going to be getting to that chapter in a bit, right? How many papers? Honestly, I'm going to be so honest. In my experience, I didn't do a lot of past papers. I just read through solved past papers and just like read through all the theory again and again. But I would suggest aiming somewhere between like 3 or 5. I don't think you need too much more than that. Retained profit is basically when you have profit, which is like a surplus and is left over after you've paid all of your expenses from the gross profit, and the retained profit can be reinvested into your business again. The discount formula, I am going to be getting to that. Are there any questions in regards to this specific chapter, finance? Everything I've gone over right now. Okay, then I'm going to be moving forward. Your next internal source of finance is your sale of inventories, which essentially is you're going to be selling what you have, your product. And the benefit of this is that obviously you're selling out your product, you get like sales, you get revenue, and it also reduces, like the more you sell, per month or per week, depending on your business. So, for example, a fast food restaurant expects its inventory to empty every 3-4 days. However, a company such as a fashion warehouse expects their inventory to, not turn over as quickly. So, around 2 months, 5 months, something. So it depends, and the quicker you sell out your inventory, the less holding or storage costs the business needs to bear, because the more inventory you have at the moment, the more area you need to store them. But the less inventory you have, you're going to need only like one warehouse, half a warehouse, etc., etc. Please hold on to your questions you have regarding other chapters. I'm going to be going over all of the chapters one by one, but it really like breaks the flow of whatever we're doing. Okay, so then we have the owner's savings, which is basically, again, it's sort of like your capital, but it's mostly related to sole trader or partnership businesses, which aren't registered formally, right? So the advantage is that it's going to be like quickly available to the firm, and since it's from the owner's own pocket, it's not owed to anyone. It doesn't have to be repaid. It doesn't have any interest on top of this. However, it increases the risks which are taken on by the owners. So if the business flops, the owners are going to have to, bear the cost of it. They're going to be bearing the risk, right? After this, you have your external finance, which I told you like a few minutes ago. It's finance which is obtained from outside of the business. So this refers to your shares, your loans, overdrafts, etc., right? So first up, you have your issue of share, which is just like a thing for limited companies, such as your PLC, private limited companies, or public limited companies. And essentially, how shares work is that you sell off tiny parts of your company to people. So, in a private limited company, shareholders are like privately vetted by the owners. So, for example, in a private limited company I'm running, I'm going to pick a few of you from chat and I'm going to be like, hey, do you want to fund my business for yada yada, this amount of profit? And you're going to be like, yeah, sure. And that's how a private limited company works. However, with a public limited company, it's a little different. So it's basically going to be me just like posting a thread or something saying, hey, anyone who wants to buy and fund a share of my company. And I essentially can't control who buys the shares, but I still will be equally liable to each of my shareholders in terms of profit they get and ensuring that they do get all the shares on time. So an advantage of this is that it's like an easy way to gain large amounts of finance, especially for a public limited company, because there's like a mass of people just throwing in, which seems like insignificant amount for them. But when you're sharing like 1 million shares per dollar, even if every single one of this 1 million people pay $1, you're still raising $1 million for your business. So it's like a really good way to mass gain your funds and stuff, right? And the best thing is there's no interest. You only have like this tiny amount of profit you're paying everyone. However, this can also be argued as a disadvantage. I don't believe it really is a disadvantage per se, but Cameron says so. So the dividends or the shares of profits that have to be paid to the shareholders do, in a way, decrease your total revenue that you get in the business. The businesses have to pay dividends. The businesses do have to pay the dividends, but it depends business to business whether they pay per month, per week, or per year. It's usually done per month from what I know, but they can't avoid it because if they don't pay dividends, the shareholders don't really have a reason to, continue buying and retaining those shares, if that makes sense. Okay, Evie. Also, another thing, which is a big risk, and it's happened a lot of times with giant public limited companies, is that if one single person gets hold of a lot of shares, so usually in companies, in limited companies, what happens is that a business shares around 49% or less of its total shares and retains at least 51% of them, right? Because if they sell more shares than they own, there's a risk of someone, going out of the way, buying all of the shares. And then this arises something that's known as ownership dispute, because the new person with more shares of the business, they're going to come in and they're going to be like, now this is my business because I own it more than you guys. And this can potentially harm the business as well as the owner, because they're essentially losing ownership of the business, right? Anyways, any queries? Also, I don't want anyone fighting in my chat, or I'm gonna ask one of the mods to mute you. This is a business session, it's not. Identify two reasons company can low this risk of break even. I'm getting to break even in a bit. Owner savings equivalent to. Owner savings are not equivalent to retained profits. I'd argue they're more like capital, because the owner is essentially putting in more money into the business from their own pockets, whereas retained profits is essentially the revenue you get from sales and then minus all the costs and the expenses. Collateral security. Collateral security for shareholders, as I said, it's essentially the fact that if one person managed to get hold of a lot of shares, it causes a lot of ownership disputes, which can, fuck over the business. Retained profits do not have to be put back into the business because, again, owners keep some of the shares. Dividends are paid from the retained profits, but most of it is, preferred to be put into the business to keep it running. Any other questions? In overdraft, I'm getting to it right now. Okay, so moving forward, you have your bank loans, which is really obviously money that is directly borrowed from banks. And it's a quick way, especially for a well-established business, and you can pay it back over a course of like a month, a year, depending on how big the loan is and what your contract states. And larger companies can get like really big loans for like very low interest. However, oftentimes, like more often than not, it's not even a question at this point. Most loans do require companies to pay interest, and the interest grows every day they don't pay. So it can be 1%, the next week is 2%, etc., etc. And if it goes on for a very long time, the interest can grow a lot, which leads to, a loss to business. And again, the loan itself does need to be repaid. And oftentimes, especially for smaller firms, they do need to get like a collateral to the bank. So in case they aren't able to pay off the loan, the bank is gonna, seize up whatever they have as collateral. So it can be a building, it can be a piece of machinery, whatever. If you can't pay the loan, you just sold off your loan thing in exchange for the loan. Right. There's also the issue about debentures, which is essentially that people will buy loan certificates, but the finance of wait, I'm sorry, I'm messing over my words right now. Yeah, okay, my bad. So debentures are like another type of loan, as I was saying, and essentially it's like a certificate of a loan more often than not. And again, this specified loan needs to be repaid. And so it can be used to raise like very long-term finance, since debentures are often longer than loans. So whereas your average loan is like a year, 2 years long, your debentures can go up to 50 years or so. The difference between debentures and share issue is that people are gonna buy debentures from the bank directly instead of like the company. But interest has to be paid on the debentures, whereas on shares you don't have extra what do you call it? You don't have extra interest per se, but you do have to pay dividends, which are profits. And the loan itself needs to be repaid to the bank. On top of that, your extra interest. So in the end, it does cost you more. However, over the span of like 50 years, 35 years, it does significantly ease out your financing. This is like a more long-term solution. Shares don't pay any dividends. No, on shares, you pay dividends to the people who bought the shares, because again, if they didn't. Okay, so for shares, businesses do need to pay dividends, because if I'm buying a share of a business, I'm sort of funding them. So I expect something in return. So I get like a tiny share of their profits, which is a dividend, right? Examples for this. Examples for what exactly? Let's I don't think preference dividends are in your syllabus right now. Yes, dividends are a bit of profit the company makes. Mm. Okay, Optimus Prime, I don't quite understand your question, but I'm going to answer it to the best as I can. So what I'm assuming is that you're asking, in what scenarios do businesses get loans as opposed to the other sources of finance? Yes. Dividends do not come from shareholders investing. Dividends come from like them selling out products, and from the retained profits, it's like a part of said retained profits. Okay, Optimus Prime. So basically, when a business wants like a short term, quick fix, if they have like a big payment they need to pay off, they're gonna go for a loan. Shares are a sort of long-term finance, so the business has like a never-ending supply of cash, which comes in from different people. So it's usually established like before the business, registers itself that yes, we want to sign up for being a limited company and sell shares. Debt factoring, not debt factoring, sorry, debentures are again similar to how shares work, but they can be done later on after a business is established, so they don't have like the commitment of being a PLC or a PLT, but instead they do get like a few chunks of funds again and again every few years and months, depending on how long the contract is. However, the difference between debentures and shares is that you do need to pay off debentures, whereas with shares you just need to pay the dividends. Now, answer your question. Also, I'm gonna be coming to the break-even charts. I'm not gonna omit it out. Just chill out, please. Oh my god, I got 100 reps. You rippy. Hippopotamus, guys, yay. What is a debenture? A debenture is essentially you getting shares from a business instead of like actually selling out shares. So the bank gives you a certificate and it sells like tiny copies of the certificate for like specified chunks of profits or cash. However, you are only directly liable to the bank, and it's sort of like a long-term bit of loan you keep getting, but you do need to pay off the loan with a lot of interest. Clear? Do I move on? Do I move on? I will assume that's a yes, right? Okay. Next we have, which is a really interesting concept. I've seen a lot of students struggle with it, which is known as debt factoring. So debt factoring is basically if I have a customer who owes me, let's say, $1,000, I'm essentially going to sell off that loan to what is known as like another company, a debt factoring company, and they're gonna get like the customer, like, so later on when the said customer pays me back my $1,000, I'm gonna pay it back to the debt factoring company. But the reason I sold it was so instead of like the $1,000 I would get later, I instead get like $900 that I need right now. So even though there's like a long-term loss going on here, since you're essentially cutting off some of the amount you're supposed to receive, it's a good way if you want like urgent cash into your money, into your business, sorry. Your what is going on in chat? Edexcel. I mean, currently it's CI's business. I don't know what Edexcel business is like. Why are we talking about Krispy Kreme here? Okay, I don't care at all. Grants and subsidies. Grants and subsidies is basically when a government or, your government agencies, anyone, they give businesses what's essentially a grant or a bonus, which is often intended to, debt factoring. Yeah, sure. I'm going to go over debt factoring again. So, debt factoring is basically a business selling off the debt that it's owed to another business to get like a fixed amount urgently. So, for example, if I have $1,000 I'm owed, I'm going to sell it to someone else, and in turn, they're going to give me $900 on that $1,000 that I sold to them. So later on, I'm going to get the $4,000, and they're going to make a profit of $1,000. Whereas I, lose $100, but I did get the amount I needed urgently. So sort of win-win, right? Again, questions? No questions then. Okay. Moving on to grants and subsidies. As I was saying, grants and subsidies are provided by the business, provided by the government to a business in order to, facilitate their growth. So it's often done in developing countries or to promote debt factoring again. Right. So debt factoring is when you sell your debt. Like if I'm owed an amount, I'm going to sell it to you. So you can pay me the amount right now that I need to, pay for something. And later on, when I get the amount I was owed, I'm going to give it back to you. Understandable? Oh, what's the advantage of playing? Ali, I'm going to get to that question in a bit. I'm currently doing finance right now, so if you have a question related to that, please feel free to ask. Anything else? I did send the link of the website somewhere. I'm going to send it in chat again, but I'm also going to be sharing it after everything's done because my lag's really bad. So I'm not able to switch between chat and out again and again. Yep, the message is stuck. Okay, moving on. If anyone doesn't have questions. So, do I need to explain grants and subsidies again, or did you guys catch it? ALY, this is a CI session. If you want a tutor, you can go ahead in the Edexcel thread, if there is any. Okay, so moving on to microfinance. Microfinance is basically smaller institutes which are set up into developing countries such as Nigeria, Pakistan, and companies where their own industries are not that well built, so they provide finances to business who want to start up, so they can run without the fear of capital or the lack of capital thereof till they're strong enough to survive on their own. Then we have crowdfunding, which is similar to shares, but instead of, paying them, it's sort of like how, indie devs on Instagram, you've seen them, they start up Kickstarters, or they use Ko-Fi to raise funds to, work on their product. And this is usually done before launch or before new products are introduced. And this is on a more voluntary base. So for this, you do need to have like good brand image and marketing beforehand, such as on social media or more in physical advertising. So people, even if you don't have a product yet, or if you're planning on starting something new, you're going to be having a lot of people. Okay, moving on. You have some more external but short-term finances. Overdrafts, for whoever was asking, overdrafts are sort of similar to loans, but um yes, this was IGCSE. Yeah. Overdrafts are similar to loans. However, you do arrange it beforehand, and overdrafts are not always withdrawn. It's more of a fail-safe. So, in case you ever withdraw more from your business bank than you have in account currently. So, for example, I make a purchase of $2,000. However, I only have $1,500 in my bank account. The bank's gonna charge an overdraft, and the overdraft, it does vary each month depending on how much I've already agreed to with my bank. But it's really flexible because on the months you don't withdraw the overdraft, you don't need to pay anything, and you only pay interest and the loan if you actually used it, which is not often. But it's also cheaper and more efficient than actual long-term loans because you can just like withdraw it and pay it and settle it later, and it's more short-term. However, the few disadvantages is that interest rates can, vary according to when you withdraw. So it might not be very high one month, and the month you suddenly decide to use your overdraft, it just skyrockets and it's like, oh yay, 50% interest payback, bro. So it can be quite risky for a business. And the bank can also sometimes, ask the business to pay back the overdraft on a short notice, and if not, they can be repercussions. So this is like some things to note. Trade credits are when a business delays payments to their customers to improve their, sorry, not customer, suppliers, to improve the cash position. So for example, if they're like really low on cash and they have like a lot of payments that are pending, or if they have like one huge fish they need to pay off before everyone else, they're gonna request some time, they're gonna request a grace period from their other people they owe, like banks and stuff, till they gain back some of the missing revenue, they fix their liquidity issues. And however, disadvantage, if I don't pay someone quick, or if I just put them on hold for a really long time, they may not want to work with me again. So this can be a really risky method to go for. So, in conclusion, your loans, debentures, shares, etc., are your long-term finances, and the ones we discussed just now are your short-term. And what determines if a business uses a long-term or short-term source of finance is essentially how quick do they need the money, and how bad do they want it, and how well or how soon are they able to repay it? Is it difficult for them? Are they a new business? Have they been in the game for a while? So these are everything you need to consider before you write about a business using said source of finance, right? Another few sources of finance are your hire purchase, where you're essentially buying a fixed asset and you pay on it for monthly installments instead of at the same time. So even though the firm doesn't have like a large amount of money, they don't pay a large amount, but they still do get to use the asset beforehand. Kick out ally. You know what? Let me ask one of the mods to try and kick him out of the stream. I'm really sorry, my thing's bugging. Okay, anyways, where were we? Oh, give me a second. Goddamn. Okay, yeah. We're currently doing finance. I'm going to be going over everything else. Yes, we're getting to break even. Please cut me some slack. Any questions regarding hire purchase, or any of the other things we have discussed up till now? Okay, then we have leasing, which is sort of the opposite of hire purchase. In this you use an asset without purchasing it, so you're giving like it's sort of like renting, right? And so when they lease it, after the leasing period is over, for example, a month, like not a month, but like a year or so, so 12 leasing payments, and they can decide if they want to buy the asset or if they want to continue using it on rent or on lease, right? And the advantage is that, again, the firm doesn't need to give out large amounts of money, and they can still use the asset. Plus, another advantage is that the maintenance and stuff like that is done by the leasing company. So I don't have to pay anything extra if the machinery breaks down, if it needs like, regular fixtures or anything, which saves me on maintenance costs. However, a disadvantage would be that sometimes the cost of leasing the asset could end up more than if they actually bought the asset for, a lesser price than that. Okay, now, as I discussed before, what affects why a business chooses a specific sort of finance is the purpose. So, if it's like a big purchase, if it's just to improve cash flow, liquidity, disadvantages to leasing. There's not a lot of disadvantages to leasing. It's just the fact that, you are liable if there's a lot of damage done to the asset you're using, which could cost you paying the leasing company for damages, or again, it could end up being more than the actual price of the machinery itself, right? I'm fine with it being recorded. I just can't record it myself. So if anyone else wants to, I'd be more than happy. Can you do leasing advantages and disadvantages? Yeah, sure. So, for example, I want a machinery that packages my product. So we assume I'm selling soap bars, right? So I lease out a machine that does the packaging for me. So I lease it for around a year, and I'm paying the leasing company around $100 per month for that. And the machine itself, it costs around $1,000. So at the end of my leasing period, I can decide if I want to buy it, but if I don't buy it and I continue using it on lease because I don't want to pay uh you know $2,000, but instead if I keep on leasing it for 2 years, it's gonna cost me around $24,000. So if I had bought the machine beforehand for just $2,000, I would have saved an extra $400 on that machine. However, it does end up being advantageous because my cost per month was like lowered. I didn't need to buy out the whole machine, so it saved me on short-term cash. I did not need to spend a lot on maintenance costs or regular fixing. And as soon as I felt like I was done with keeping the machine, or if I didn't have space, I could just return it back to the leasing company without it becoming a hassle for me. Does that make sense? Why are we talking about batch production in chat? Hello? leasing overtaking a long-term bank loan. The advantage of leasing over a long-term bank loan is, again, I don't need to own the machinery to use it. Plus, there's a less rate of interest, because if I get like a $2,000 loan out of a bank, I'm gonna have to pay what, like 2% interest, which amounts to, I don't know, $400. I'm not good at math. But yeah, essentially leasing is better since it costs you less per month or per leasing cycle. There's no interest, and you can return it at any time you want once your leasing period is completed, right? So I can't be the best. Break even and past papers. I'm gonna get to past papers in a bit, right? Some people do need help with the syllabus itself. Break even. I really want to ban the word break even at this point. I did mention like 10 times now that I'm gonna be getting to break even. Anywho, in your answers, this is a past paper related thing. During your answers, if you get a question that asks why a business should prefer a specific source of finance over the other, and you get like a bit of context, or just in general, you need to consider why the business wants the what do you call it, this source of finance in the first place, and also how long do they need it for? Leasing real quick. Oh my god. The thing about leasing, like the example or the definition? Currency appreciation. Isn't currency appreciation and depreciation an accounts thing? I haven't seen it in business. Production here. Section things. Okay, I might not remember what it was about, but I'm gonna check over section 6 when we get to it, right? How do I business? I think it was, yeah. Okay, anyway, if there's no question, I'm going to be moving on. Everyone understand what factors affect sources of finance? Or do I need to explain it again? I'm not going to be going over it again. Thank you, Drum Kitty. I love you. One more what? Chill dive? I do think the session will be recorded if someone else does it. I'm not recording on my end. Finance factors again from top down? God, you're all gonna kill me. There's no best method of finance. It depends on what the business needs. So as I was literally explaining just now, a business may need a short-term source of finance for big purchases, immediate repayments. However, if they want to increase their funds or the capital long term, they can opt for selling shares, debentures, etc. So it just depends on what the business needs at the time. Some examples of government grants. I'm not very I low-key don't know any specific examples. But I think I heard like there's a lot of kinds of agricultural grants. Governments give farmers to, work on their crops and stuff. I've heard of governments giving out tractors and this sort of stuff. This is an example of a business of getting a subsidy. Grants can also be cash bonuses, and fun fact, business grants can often be non-monetary. So for example, if they want a business to, businesses to grow in a specific area of the country, they can, offer them warehouses, they can offer them, petrol and stuff that helps them without, the expectation of immediate repayment, if that makes sense, yeah? Risk gearing is a risk gearing in which source of finance? We're gonna get to production in a bit. We're on finance currently. That's production flow. There is no best production. It depends on. Risk gearing is essentially a business weighing out if the steps they're taking are worth the risk. Because if a business takes a risk which is like more detrimental to the business if it goes wrong, or if it's just like more costly or expensive in contrast to how much it gains. So for example, I buy me a machine that costs me $5,000, but I only make and sell around 100 products from that, which only gets me like $3,000. So that's going to be a big risk because I don't see me, profiting off of said machine. This also can be used in terms of, expansion where you want your business or outlets to be placed, what you're marketing towards, etc., etc. It depends on the scenario, obviously. What? The best way to take a loan is either by just going out to the bank and begging them for a loan, or another best, not best, but like preferred way for small businesses is again crowdfunding, which is starting up Kickstarters or Ko-fi to gain fundings, because banks are, as we discussed before, they don't really prefer giving out loans to smaller businesses. Economic part, we're gonna get to that, yes. Okay, if there are no more questions related to finance, I will be moving on to next chapter. Okay, we're going to go to cash flow forecasting and working capital. Any objections? Any questions? Yes, we'll be doing past papers later on. I am using IGCSE Note 8, so do check it out yourself, I guess. Okay, so cash flows. How familiar are you guys with this concept? Cash flow will too big for business in which situation? Businesses, usually for large businesses, it's fairly easy for them to get a loan because, again, they've shown that they can pay off the loans, especially if they have a history of getting and paying up loans. Now, if the cash flow is too low, businesses may, take some collateral thing in between them. So if in the case of the business not being able to pay off the loan, the collateral thing is going to be taken in by the business. So this can be a car, a vehicle, a warehouse, anything. So gone over what? The business doesn't have bad history of loan. They're not going to be able to get a loan then. So they're gonna have to rely on selling up shares, crowdfunding, or other sources of finance since the bank isn't stupid. Lucky. A statement. Oh, no, we haven't gone over the statements yet. It's the unit that should be most attention. I honestly don't remember. I'm gonna go going over everything. It's been a while since I've done business, around 2 years ago. Business, can you just put your capital into a savings account? You could put your capital in a savings account, but you want to put into the business, no? Because that's the way the business is going to run with the said capital. Okay, anyway, if there's no more questions regarding what we've discussed, we're going to move on. Yes, so liquidity refers to how well a business is able to, keep its cash moving. So it comes from the term cash flow, because cash is meant to flow. So if your cash is stuck in one place, if you have too many fixed assets and not enough cash to keep moving around, that's like low liquidity. But if you have more cash at hand and money to, throw around, that's high liquidity. Does that make sense? Okay, yippee. Business plan. Eventually, I don't understand. What are you trying to get at with your questions? Business plan's bad considering. Anyways, cash flow. I'm ignoring chat for now. Cash flow of a business is essentially cash flow, so the cash that goes out and the cash that comes in. So inflow cash is them getting sales revenue, bonuses, subsidiaries, anything that comes into the business and the business can use. Cash outflow refers to expenses, payments, costs, the payments to suppliers, etc., etc. A good rule of thumb is that a business strives to, increase its cash inflows and decrease its outflows because, they want more and they want to give out less. It's basic corporate greed. We discussed some ways of, gaining finance, and these all techniques refer to your cash inflow because you're essentially bringing in cash. However, your cash outflows could be purchasing goods and assets. It can be paying out your rent. It can be your salaries and wages you give to your employees. It can be purchasing assets. It can also be paying your suppliers, your creditors, your debtors. It can be paying off loans with like interest and stuff. Anything that, decreases the cash from your business is your cash outflow. So one thing I've noticed is that cash flow is not like the same as profit, because profit is the surplus amount you have left over from your gross profit, which is like after you have all your expenses, your other payments you need to make paid from your profit, from your gross profit, you have your retained profits left. However, cash flow is not only just your revenue, it's essentially all of the cash that comes into your business. So this can be loans, this can be, trade receivables, anything that comes into the business, your capital even. That's all cash inflow. Cash flow isn't just profit. I'm not going to be going over cash flow statements right now because frankly I don't remember it and I don't want to fail you guys, so I'm just going to be skipping it right now. So the way cash flow problems are created is essentially when a business has most of its cash stuck in one place. So it has to do with liquidity. If the business isn't able to, sell off and keep its money moving, it gets stuck in a position of, lower liquidity. That means it has less flexibility on what it can do with its cash. And this leads to a lot of problems, such as, this increases the amount of loans you need to take to, pay out your suppliers, to pay dividends to your shareholders if you have any, to, keep the day-to-day business running. It can also result in, delayed payments to your suppliers. So if you don't have enough cash at hand, you're not going to be able to pay the suppliers when you need to. And it can create a lot of discontent between the people you owe cash to, since they're going to be hesitant to work with you later on if they feel like you don't pay them on time. And this can also delay a lot of purchases of equipment. So if I don't have enough cash to buy, for example, a pancake machine for my business, I'm not going to get the pancake machine, and in turn it could affect my business negatively, since the output I would have been producing with the pancake machine is not there yet. Make sense? Also, please, I do request keep chat relevant to the stream. It's really confusing for not just me, but also the students who have actual questions and they just get buried under walls of text. Okay, if there are no questions, I'm going to be moving on. I'm going to try skim through it, so please pay attention. Working capital, again, going over it just because it's written here, is the capital that is needed to run your day-to-day business. So different from startup capital. Startup capital is the capital that's invested, at the first very beginning stages of the business. However, working capital is capital that an owner invests to keep, day-to-day things running, such as minor expenses, wages, small expenses such as machinery, like tiny machinery, office supplies. Coffee is a sort of expense that needs your working capital, etc., etc. Any questions? Yes, I'm going to be covering section 6 in a bit. Analysis of accounts. Okay, we're not doing these three because, again, I don't know financial information that well, and I don't think that comes into paper 1, right? Okay, so moving on to question 6. Yay. Okay, so an important concept is your business cycle, which is also sort of like your economic cycle. So this has to do, for those of you who take economics, you must be aware of this concept beforehand as well. This is known as your GDP. For me, this is known as your business cycle, and all your businesses and economic environments go through the cycle like on loop again and again. So your first stage is your growth. It's when, everything's flourishing. The GDP, gross domestic product, is rising, unemployment is at an all-time low, and people just gradually get higher living standards, and businesses in this time are going to try expand as much as you can, right? And then you have a boom where GDP reaches its highest peak, and inflation is very controllably and controlled rising. So businesses, in this time, they have like more costs, but also they do have like a lot of profitability due to these high costs because they're able to charge higher profits. However, in this period, there is a risk of, things getting out of hand and the businesses start to worry about the costs. If they continue rising, that means that it will reach a point where the products and their costs are too high to be able to sell at the same level of profit. So they need to lower the profit just to be able to cover the cost. If GDP is high and employment is low, how can businesses maximize growth? So when GDP is high and that doesn't really make sense because GDP refers to, you know, product that is made by employee per. GDP is gross domestic product, essentially how much output a country can pump out in total without any extra costs and not costs, what am I saying? Without any, expenses or something cutting down the median. It's like the total of everything they produce. Exports, yes. I'm sorry, I forgot the word. Without any exports being counted as an amount. Any more questions? I haven't touched recession yet. I'm moving towards it, yes. Section 6 does come in paper 1, yes. Okay, so recession is when the GDP is going to start falling because of high prices and demand. So spending is going to fall because people can't afford such high high prices. So in turn, demand is going to fall rapidly. And due to this, firms are going to cut back production. They're going to produce less due to higher costs and low demand in order to, keep themselves running. And so unemployment is going to rise due to businesses, as they cut down production, they're going to let go of employees, they're going to close down factories and stuff. So it's a really bad time to be in. A slump is when GDP falls so low that prices are going to fall, right? And employment is going to reach very, very high levels. And so many businesses are going to shut down, especially smaller businesses or businesses in very niche markets where they're not very profitable. So this is going to be the stage where a lot of businesses close out. But it's also oddly advantageous to big firms, since if they retain enough profits from, the boom or the growth period, they're able to survive the slump. So that puts them in a position of power, and they can in turn, during the next growth, have a monopoly over their industry. Okay, so a business during a recession and slump would close down due to a variety of reasons, because higher prices does not always mean higher prices does not always mean higher profit, because if it usually takes me around $50 to produce an ice cream, let's say, and I have my profit on it for $20. However, costs rise, so that $70 ice cream, where it used to cost me $50, now costs me $70 just to produce it. People aren't going to be willing to buy it if I still keep my $20 profit margin, since it's going to make the single ice cream be $100. So either I'm going to be like selling the product in loss, so $70 still, but I retain no profits, or I'm gonna still bump up the profit, so I'm gonna be selling it at $80 instead. However, it's still very low of a profit than compared to the $20 I used to get during my growth period. If that makes sense? Please keep discussion relevant to stream. I'm so tired. I will go through past papers later on during some point in businesses. Just keep noise. During slump, businesses do try keep prices low as possible, but again, it's not really possible if the lowest price is essentially just the cost, because for businesses, cash inflow is really important. So if I don't get enough profit, if I don't get enough cash inflow to, pay all of my employees, pay rent, even if I sell my stuff at the lowest possible price, if I can't keep up with all these expenses, I'm going to be driven out of business, because I'm going to be in more debt than I can feasibly recover from. since employees aren't going to get their wages, machinery isn't going to get fixed, warehouses aren't going to get paid for, and I might lose them. I might be evicted from my office building, and this is why businesses shut down. For larger businesses, they usually just go for, survivability, and they use their retained profits from periods of growth to keep them running before the next boom or the next growth period. We're gonna go over everything before the past paper because most people opted for me to cover the whole syllabus. For definition of recession, it's a decrease in GDP for not 6 months. Do check that value from Google again because I don't exactly remember, but it's not just the fall of GDP, it's the fall of GDP due to high prices, and it's also when employment falls. So high GDP, low GDP, high prices, and low people employed, so they don't get enough, income to spend. How does cutting back production make business more profitable? Cutting back production allows the business to. Prices will be high in a recession because the cost of raw materials is going to be high. Cost cutting helps business become more profitable because they're going to try and minimize like the redundant stock. So for example, if I produce 100 units and it's usually just like 70 units selling, I'm going to try cut back my production to just a bare bones minimum, so just 70, so I don't have to bear the cost of extra units that may or may not sell. Inflation refers to Jesus Christ, I forgot the definition. I'm so sorry. Give me a sec. Oh, the questions are tiring. Inflation. Yes, so inflation is the rate at which the level of prices rises, and so the purchasing power declines of people. It usually has to do with exports and the government when they export stuff at such a high price that the cost of those materials which are needed to make the products becomes too high, and paired with low employment, it means that consumers cannot afford those products as they used to be able to before. Any other questions? I don't know. I'm gonna be so honest. You know what? You'll tell me, do you want me to jump into past papers right now, or do we cover up the motivation theories and then jump into past papers? Because I feel like if you don't get the syllabus, it's going to be really hard for you to really understand what you're meant to do in the past papers. I can't put a poll up here. Syllabus is, so we're going to continue for the syllabus right now. Give motivation. Okay, yeah, sure. Syllabus it is. So I'm gonna skim over stuff right now since some of you are very impatient. So during times of economic difficulty, what a business wants to do is essentially keep itself stable enough And they also want to milk out as much as they can from growth period, because the slumps and the recessions are quite frankly inevitable. So one thing business may want to do is maintain economic growth. So when GDP is high, more goods and services are being produced than the previous year. And so the country's incomes rise and people are more likely to buy products that they may have previously not in a survival state. Like, how many of you go out to a cinema or a fancy high-end restaurant when you're feeling rich? However, when as soon as your salaries are low, if you feel like you can't afford basic needs, you're not going to go out of your way to go for luxury goods or buy more stuff than you want, right? So that's essentially why businesses want to maintain a period of growth. They also want to achieve what is known as price stability, because changing the pricing too often leads to a higher cost of the business, since they've got to read over each price, why they want to increase it, and then they work on marketing that new price. I did answer what is liquidity right now, but I'm going to take questions in the end. Let me finish. So during inflation, when average prices of goods increase over time, so there's some like low level inflation does help the business to raise their profitability. However, if there's like very high amounts of inflation, that would mean that costs go insanely up and people can't keep up with the rise in costs of each item, which would eventually lead to a declining demand, and in turn it would mean the business isn't selling as much as many goods. So it would result in them losing sales, losing revenue, losing profits. Also, this is how I want you guys to structure your points in your exam. So if the question asks you why businesses want to maintain stable pricing, I don't want you guys to say, oh, just so yada yada. I want you to clearly explain why they do it and how it affects the business, in what the results are of maintaining price stability. Don't dump a mag of information, connect with it. Reducing unemployment is pretty straightforward. I'm going to skip it for now. Reduce income inequality is also pretty self-explanatory, since you have like your customers, and if they have like a higher income, they're more likely to spend, impulse spending, and when you maintain the balance of payments, this is essentially a country's exports, meaning your goods, services that are sold, and your imports, goods and services that are bought into the country. If there's like too many imports as opposed to your exports, you're going to be in a trade deficit, which means that you're essentially spending more on getting your supplies, instead of actually what me my mind is so tired right now, instead of like selling out your goods and services to other countries. You don't need to know economic policies, I don't think so, but if you want, you can read through them later. I'm going to be skimming over stuff right now. Okay, do you want me to elaborate on ethics and stuff in section 6, or just skip to motivation? Reducing unemployment. Reducing I think it should be reducing unemployment. Might be a typo, because essentially the economy aims to reduce unemployment, so more and more people are working, and so there's more, GDP per capita, which means per head. And so when unemployment is low, that means more people have better incomes, which means more spending by your average people. And in turn, businesses can profit off of more, goods that generally wouldn't be bought in terms of, economic survivals. Because again, if you're poor, you won't, really prioritize going to the cinema. However, if you do have like enough cash, or if you're like rich enough, like bluntly put, you're gonna go over to, different stuff which generally isn't important for your survival, but you're still gonna be supporting those businesses. Okay, so we're gonna skip over ethics and stuff, because again, that's easy. So we're gonna go over motivation. For those of you who do want to go over the whole syllabus, you know what? I'm going to be skipping them right now. But after past papers are done and majority have left, you can ask your questions and I'm going to go over the skipped chapters once again. How's that sound? Okay, right, fair enough. One chapter is the most important. From what I've heard from your IG peeps, I think chapter 1 and chapter 5 are the most important, yeah? Anywho, just going over motivation really quickly. So motivation is essentially, I forgot what acid test ratio was. Give me a second, let me look it over. No, I'm skipping your calculations because I'm not very qualified in them. If you learn them from me, you're gonna fail. Don't trust me. Anywho, any questions before we start motivation? Okay, good then. So motivation refers to people wanting to work in a company. So the basic needs, or like the basic thing that motivates people to work, is, having a better standard of living, being secure, being respected, and, having status in society. So, why people go for higher paying jobs is because, they want good income, they want a better reputation among their peers, and, they need security that they're not going to be left out on the streets fighting for survival, right? And motivation in the workplace is really important for a business because they want to keep their employees efficient and happy to work with, because it's similar to how, you do good in a subject you like versus a subject that you hate. Because if you have an interest in it, you're more likely to, spend more time on it. I'm getting to that, Avenger. Please give me a second. So we have why motivate and what is motivation. Now we're going to go over motivation theories. First off, you have your F.W. Taylor theories. Theory. Fuck. Okay, so Taylor says that workers are motivated by personal gains, and by personal gains he means money. So the money and the increasing pay would increase productivity in a business, because people do want to earn more. And this is a really narrow view of thinking, if I say so myself, but it's one of the first theories we have. And so Taylor says that if workers are paid by the level of output, or by the time they put into the work, they're more likely to, be more efficient in what they produce. However, again, this is not entirely true, because there's a lot of other motivators in modern workplace which are more often than not more important than money. So we're going to be going over them. My personal favorite theorist, Maslow's hierarchy. It's fairly simple. Maslow has a hierarchy, which is your physiological needs, your safety and security needs, social needs, esteem needs, and self-actualization. Your physiological needs are your basic human needs, which is food, rest, shelter, and just general stuff you need to live, right? So this would mean your wages just enough to meet these needs. What is going on in chat? If you guys want to fight, just don't speak at all. I'm gonna ask someone to mute chat altogether. None of you are gonna be able to ask questions then. Anyways, then you have your safety and security needs, which is, protection against poverty, danger, and, hazards. You need fair treatment in the workplace where your life isn't in danger. So this refers to job security, hazard pay, all of that sort of stuff. And after you have your needs met, like the base needs, you're going to have your social needs, which is, a human's inherent need of, working in groups, having friends, colleagues, and, just like generally being surrounded with people. And this is done in workplaces such as, teamwork, team building activities, etc., etc. Then you have your esteem needs, which is, praise, independence, recognition, all that sort of stuff. And then you have self-actualization, which is essentially just the person wanting to be the best that they can. Now, even though this is a pyramid that seems to go from bottom to top, you can't have self-actualization if you don't have your basic physiological needs met in the first place. So it's important to go step by step, right? Oh my god. If you guys are done fighting, are there any questions? Okay then. Then we have Herzberg's two-factor theory, which is essentially that he says that people have two sets of needs, and this is one of the most widely agreed on theories. So you have your basic needs, which Maslow had dubbed as your cycle of physiological needs, such as hygiene factors. So your hygiene factors are work conditions, your policies, fairness, salary, the status, security, and everything that ensures that the workplace you work for is not toxic, right? And then you have what's known as your motivators, which is achievement, recognition, pride, personal growth, and the nature of the work you're doing itself. And so, according to Herzberg, the hygiene factors are, unnegotiable. In order to motivate your employees, you do need the hygiene factors. Without it, they can't be motivated. However, without the hygiene factors, workers aren't going to be motivated, no matter how many motivators you put them. But what sets this theory apart is that Herzberg says that hygiene factors on their own are not sources of motivation itself. So you do need external, the motivating factors to, have employees be motivated, right? There's no best way of motivation. It just depends on the type of HR you have. So whether it's hard HR, soft HR, and what the need of the business is, what the employees are doing, etc., etc. Then you have your, oh my god, you only have 3 theories. You guys are so lucky. After this, we have financial motivators. The theories are often asked in papers, at least in AS papers, and I think I did 2 questions on theorists in my own O-level exams as well, so I would say they're important. But they're not also very hard. You can tie them into almost any essay question from experience. Any confusion? Or should we move on? I did share these notes somewhere in chat. I'm going to share them again. If the thing gets uploaded in the description and also in IG Business, so someone can pin that. Thank you so much, Walter. Any questions? Okay, then moving on. Financial motivators. You have your wages. Again, pretty obvious. It's essentially paid weekly or calculated based on your time rate. So number of hours worked, or piece rate, number of products, or how much of an employee produces. And it's usually like per hour you get paid $50, per piece you get like $10, etc., etc. It varies based on the work and based on how difficult the job is. However, wages are used for more low-level jobs such as construction workers, bakers, etc. For more high-level jobs such as like your casual white-collar jobs, you get paid salaries, which are paid monthly. However, salaries are often paid paired with what is known as commission. So commission is, by base definition, it's paid to salesmen based on a percentage of sales they've made. So for example, I get paid $1,000 as my salary. My monthly salary is $1,000. But on top of that monthly salary, I'm paid an extra $10 based on every sale I make in the company. So if I make 50 sales in the entirety of the month, I get an additional $50 on top of the original $1,000. That's my salary. And commission can vary, so it's a good way to keep your workers motivated to produce more and make more sales. They're not really similar because wages are directly calculated based on time rates and piece rates. However, salary is a fixed income that you get every month no matter what. Then you have your bonuses, which are additional amounts paid to workers based on their performance. Oftentimes it's done annually, but it can also be done every 6 months, every month, depending on the company and what kind of hierarchy they follow. And yeah, it just essentially motivates workers to be on the best behaviors to get the bonus. Then you have performance related pay, which sort of ties into why bonuses are awarded. I think businesses are going to file for bankruptcy over bonuses. No, that's not really how it works, because if a business is already struggling and they start handing out bonuses, that's just a big mistake of a business. I don't think any sane business owner would do that. Plus businesses deal in millions in bonuses on for regular employees. I don't think it's going to be that detrimental. Commissions are similar to piece rates, yes, in a way. It's just like commissions are usually a bonus on top of your salary, whereas piece rates are just piece rates. That's your entire salary. That's it. Then you have performance-related pay, similar to the reason bonuses are awarded for good work. Performance-related pay is basically paid based on employee performance. So you usually have a manager or a supervisor who goes through all of the employees, how they work, the effectiveness, the efficiency, etc. And oftentimes these use paired with like general observation. There's interviews and comments from your colleagues and stuff. And if they think you're like working really hard, you get a higher pay compared to someone who's slacking off, right? But then you have profit sharing. Again, a very white collar thing. It's when a proportion of a company's like profits are distributed among the workers. So for example, a business gets like $1 million dollars in, profits, they're gonna, distribute around 2% of all the earned profits among the employees. So the employees are more motivated to, work harder, so the business gains more profits, so they're going to get the profits in turn. Then you have another interesting thing. This often happens in private limited companies, but this can be done in public limited companies as well. It's when shares in the firm are given to employees, so they can become, part owners of the company, and they do often get dividends for it, and this increases employee loyalty since they feel a sense of belonging. Amanda, I don't really understand your question. What do you mean? There usually is a contract or a clause stating that employees cannot sell the shares further. But if the business is stupid and they don't add such clause, they can sell the shares. Someone in a visit, other thing. There's a lot of reasons. Why do rich billionaires still feel like the need to go to the office and stuff? As Maslow's hierarchy suggests, there's a need of belonging and being a social creature. People want to work and collaborate with others. Plus, you want to feel like you're doing something productive for, as Walter said, accomplishment or achievement. Any questions, or do I move on? Okay, moving on, non-financial motivators. Most notably fringe benefits. So these are non-financial rewards given to employees, such as company cars, healthcare insurances, oftentimes university courses, and children's educations are funded for. You often have free trips and holidays funded. You often get like free or discounted accommodation, your rent, and also you get discounts and freebies on the company's firms and stuff. How could promotions be considered a non-financial motivator considering Yes, promotions could be considered a non-financial motivator if the pay isn't getting a lot increased too much, but this can be argued in both cases. So it depends on the question whether you want to take a promotion in a way of, employee feeling like they're like achieving something great, in regards to pride, respect, or if you want to take it the other way, that promotions mean better salary packages, etc. Yes, just like getting employee of the month, it does make employees feel valued. Then you have your job satisfaction, which essentially means that if I enjoy my job, so for example, I'm teaching you guys and I enjoy teaching you guys, I'm going to do it with, I'm going to do it more happily, I'm going to do it more efficiently than if I was forced and held at gunpoint, which I am right now to teach you guys. I'm kidding, I'm not. I love this. So it depends essentially, because if a worker isn't really satisfied with their job, they're gonna, try slack off or do just the bare minimum. Uh, Whereas if an employee does love their job, they're gonna, actually put in the effort and go the extra mile because it's fun to them. Then you have your job rotation, which involves workers swapping around jobs and stuff. So instead of, getting bored in one, specific area of working, roles are swapped every few days, every few hours, depending on what kind of work you're doing. Party. Okay, I'm gonna wind up this chapter and then I'm gonna head over to past papers. Okay, so don't worry. Please do not fight in my chat. I sense some hostility, but just a warning, right? Okay. So job rotation can be often done in blue collar jobs such as construction, again, since one day a person can be on the job of laying bricks, so they don't get bored. The next day they're in charge of, mixing out cement. Blue collar jobs are essentially like the step below your white collar jobs, which include a lot of hard manual labor, but are generally to an extent respected in a way. But they're more physically taxing and sort of undervalued. What color? I don't know. I think there's green color, but I'm not sure. I might be just sleepy right now. Oh, do Google it when you have time. Also, did you know that the term white collar job was a racist term? Fun little history fact that you can search up if you want. Anyways, then we have job enlargement, which essentially is which essentially means that if I work in, let's say, data science, and I work in, managing tables and stuff, instead of, just completely rotating me, this is done especially for specialized jobs where, rotation is not very feasible. I get added tasks which are similar in nature but different. So me being a data scientist, I get the job of, analyzing data every now and then. And this keeps me just like, motivated and frosty enough, but not also completely bored or completely out of my element, right? And similar to job enlargement, you have job enrichment, which involves adding more high difficulty based tasks. And so this gives employees a sense of trust that senior management trusts them to do the task efficiently. However, this can be risky and also demotivate the employee if done wrong, since they think that they cannot be, they aren't able to hit the goals they can, or they might feel overworked. Then you have team working, which is essentially a group of workers are given a tasks as a team instead of, each worker being kept in the separate cubicles so they can collaborate, again, filling out the social need people have. And then you have opportunities for training and opportunities for promotion, which again, pretty self-explanatory. People want to expand the skill set and they want to climb the corporate ladder. So I'm not going to explain that too much. Any questions? Yes, SK, you're very right. Job enlargement is like teaching multiple subjects, and enrichment is the same subject on different levels. The previous part, which one? I mean, business is technically corporate greed, so money is everything. I haven't gone through income statements and cash flow forecasting because I'm not very qualified in them myself. I suck at them, and so I don't want you guys to fail in case I give you the wrong guidance and have to solve them. Yeah, I'm not doing that. Any more questions, or do we move on to past papers, or do you guys want to go over chapter 1 and other topics in detail? Do we want to do marketing? We can do marketing. Okay, past papers first, and those of you who stick around, we're gonna go over the remaining topics then. Okay, this is the latest past paper I could solve. This is October, November 2025. Paper 1. I'm gonna go over the syllabus again after the past paper's done because apparently it's too late for a lot of people. I don't know if variant 1 and 2 are the same. I personally did 2, but most of them are the same, I think. It's just the difference of each area and the time zone. I don't have March 2026 for some reason. We are doing IGCSE, I think. Yep, IGCSE. Okay, anything before we start? Oh, no problem. Okay, we're gonna continue. This is our first past paper, so we have question number 1. You get a small extract. Why is my mouse tweaking? Okay, yeah, sorry. You get a small extract, which is some of your context. This is important to read because oftentimes you get a lot of information for your small mark questions. So WMH is a business which operates in a secondary sector. It makes furnitures, including tables, chairs. WMH's employees are all members of a trade union. The managing director knows the business is likely to remain small. She considers introducing new technology into WMH factory. She also knows that it's important for a manufacturing business to choose between a suitable location for a factory. Oh, not between, just choose a suitable location for a factory, my bad. Okay, so first question, describe trade union. So how would you guys answer this? Is just like essentially writing a definition. However, it's important to note that it's a 2-marker question. So you need 2 different points. So you can't say trade union is a group of people together. That's going to give you 1 mark. That's a partial definition. To score a full 2 marks, you're going to say a trade union is a group of people that work, that as a group of workers. That's 1 mark. And group of workers who work together to get their rights and their equality, their rights safeguarded. Yes, and that's going to get you a full 2 marks. It's like award for 2 award 2 marks for full definition. I'm sorry if I'm slurring over my words. Do tell me to repeat it if it gets too ineligible. I'm just very tired right now. So you see, you get 2 marks for this, but only 1 mark if you put a partial definition, which is just like a group of workers or employees, right? The time where I am, it's 9:30 right now, but I've been up since 4 a.m. Anywho, we have a second question, which is secondary sector. So your first 2 questions are not going to be directly related to WMH. It's going to be more generalized definition questions, right? If I take a break, people are going to leave. I don't want that right now. So you have another definition type question, which is define secondary sector. So your secondary sector is a sector that works in converting raw material into finished goods that can be sold. So this is going to be a full answer, but you don't want to just write secondary sector turns raw material into finished goods. No, you need to add that can be sold to gain full marks, right? No, it's fine. I don't need a break. Trust. Don't sit down. I think it's the time. If I had known earlier, I would have started the session way earlier. But people do need their sleep. I think your exam is in AM, right? So as we see in the mark scheme as well, product manufactured goods from natural sources, provided by the primary sector, or converts it into manufactured goods that goes into the tertiary sector. Oh my god, do you guys? Damn, that's late. I'm gonna try and wind it up really quick then. Okay, so the answer of secondary sector is the sector that works to turn raw material goods obtained from the primary sector into finished goods that can then be sold into the tertiary sector. Okay, next question. Question C, you get to write 4 reasons why a business might remain small. This is pretty standard. You have 1 point for each reason. You have 4 reasons. However, if it was 2 points, you would do the same thing you did here, 2 knowledge points for each point. However, since we have 4 reasons for 4 points, it's pretty straightforward. 4 reasons why business may remain small: because it's a niche business, maybe due to the fact that they want to retain control of the business. We don't need to explain each of the reasons, just need to state why, and that's it. Just 1 knowledge point. So in the mark scheme, if you look at it, it's like 1 mark per reason. So points include limited access to capital, personal preference, size of the market, amount of customers, there may be a niche business, there's too many monopolies, low market share, and it can be flexible and respond quick to changes. So see, there's no analysis, there's only knowledge points. Next, we have explain 2 possible effects of WMH introducing new technology. Can anyone tell me what chapter do you think we can link here? Okay, please, let's not dox ourselves in chat. You can do more past papers, but I feel like if you work on your chain of analysis, you can get like a better grade, because it's at the end of the day, it's how well you solve the papers, not how many you solve, right? Anyways, question D, what do you think can be effects? I'm gonna walk you through it. Yes, structuring answers is very important. Yes, all of them are valid points. So effect 1 would be higher productivity, and your explanation would essentially be your knowledge point. So higher productivity, or I guess this would be considered your knowledge point, and your explanation would be that higher productivity is due to more automated systems, which would lead to more output. This would be your main analysis. So more output would mean more products on the shelves, which would lead to more sales. And when you have more sales, you have more revenue, and the revenue would in turn lead to more, cash to be reinvested into the business. Yeah, efficiency is a better way. I was just quoting someone's answer. And another effect could be that workers may feel demotivated, because again, workers may feel demotivated. This is going to be your knowledge point, because they feel like they're getting replaced. More capital intensive, leading to labor size being reduced. Yes, this can be a big thing. You can also write about labor size being reduced, because again, your knowledge point being the labor size reduced. Why? It's because you're moving to more automated systems which cost less, and so in turn that would mean more employees are redundant. You need less people doing the same amount of work, and in turn this demotivates the already existing employees. However, you save long-term costs on wages and salaries. I can't download it. I don't have my stylus with me right now. It's quite dead. Otherwise, if I knew beforehand, I would have. Then you have question E, which is your 6 marker, not essay length exactly, because you guys don't have essay length here, but it's one of the most important questions because it's easy to get wrong. So in this question, you need 2 points, right? And especially since you have to justify your answer, you're going to be writing a conclusion or an evaluation and explaining 2 reasons which may or may not be, an advantage and a disadvantage. So 2 factors a manufacturing business should consider deciding on suitable location for a factory. What factors are most likely to be important? So here, what they want you to do is introduce two reasons that are 2 factors that choosing a location is important to the business. So this can be being near to your market or your target audience, consumers. And another factor can be taxes, because some areas have a higher taxation rate than some areas. Some areas grant you, government grants and subsidies. Some areas provide better transport links to your suppliers. So all of these things should be taken into consideration. Or how you explain it is you add your knowledge point. Your knowledge point is essentially going to be one factor is yada yada. So we take the example of being near to your customer base, right? So one important factor is being near to your customer base. And then comes in our analysis. Why? Because being near to your customers allows you to, ship out your products quick with less transportation costs. And due to having less transportation cost and access to more retailers that are selling your product, you're able to save on costs, and in turn, people are more likely to notice your product first since you're located near to them, which increases revenue from the surplus sales and also increases brand loyalty, because customers see you every now and then, and in their mind, it's the theory of conventions. If you see something again and again, you automatically think that they're more credible, right? However, the evaluation in your 6 marker question is going to come at the end, but you can add one minor evaluation within your point and then another evaluation point in the end conclusion, right? Could you use his answer and tell you how to evaluate as an example? Of course, let me see. So availability of labor, yes, this is another good point. If the skilled high labor is available, that would reduce training costs for the manufacturing business, therefore it's helpful. Okay, so the way you would conclude is that they want us to choose which factor is more likely to be important. However, I personally tell all of my students that try not to use very definitive language in your conclusion. So it's no, this is the best or that is the best. It's going to be something along the lines of, both of the factors are really important. However, this may be more important. You're going to be using very probable language, not definitive. So it's going to be, this may be more important because of, whatever reason. So if you go for the fact that you prioritize the transport of the raw materials, it's going to be, both of these factors are important. However, I would argue that the transport costs being low for raw materials is the most significant factor, because this leads to lower production costs. And you don't want to repeat your analysis. So instead, you're going to be like, because this leads to the business being able to lower the production costs, and in turn being able to charge a lower selling price of the of the end product, leading to more customers in lower tax brackets being able to buy the said good. Does that make sense? Did I yap too much? Okay, good. Anyone else with a question? Or do we move on? Okay, yay. Moving on, we have another question which follows a similar pattern. Again, we have an extract. CPW is a private sector business which has many objectives. It sells electrical goods, including kettles, ovens, in 36 shops across country X. CPW also offers a delivery service. The business buys all of its inventory from local suppliers to avoid tariffs. I'm not going to go over all of this, goddamn. Holy yeah. So define import tariff. Again, you would 2 points, both should be different, but one full definition, right? Next, you have two different points you need to make for 2 marks. So you can just state the name. You don't need to write sentences. You don't need to explain. You just need to identify one asset and one non-current liability. Now, we don't have any given in the extract. So you guys tell me what can be one non-current asset and what is one current liability. Yes, machinery can be your non-current asset. Trade credit is your current liability. Well said. Yep. Yes, overdraft and land. Amazing. Again, 4 marker, outline 2 ways in which information in table 2W1 might be useful to CPW. Do you guys want me to do this one? This is a question from, I think, your cash flow forecasts. Okay, so I'm going to be opening up the mark scheme for this one because I don't remember the actual content. Okay, yeah, got it. So 2 ways in which this information is going to be useful is that one, the business can see how many liabilities they have and how many assets they have, and this helps, create their ratios, their asset test ratio, I think, and as well as predict how much they need to balance out their cash flow forecast. So as we see right now, they're doing pretty good because their assets outweigh their liabilities, but they're pretty similar. So it would be best if the firm, worked on lowering their liabilities and increasing their assets. So this can be important for them to, like reason effect number one, way number one, what was it? Yeah, way number one is going to be that they're able to create cash flow forecasts, and the second point is going to be they're able to on a short-term scale figure out what they need to do in order to fix the balance of their current financial position. So lowering liabilities would, from what I see, be their current business objective, right? So again, 4 points, 2 for each. So you just need a knowledge point and an analysis. God damn, why is it such a tongue twister? So as we can see here as well, we have a knowledge point and we have application. We don't need an evaluation here. Oh, sorry, application, my bad. Yes, I did do accounting in O levels, but I dropped it just a month before my exams in favor of business. So do with that information what you will. Yippee. We any questions? Yeah, regarding question C. Or do I move on to question D? Okay, good then. Also, quick question, how many people are still left in the thing? I can't really see. Oh, okay, good enough. Explain two factors CPW should consider when deciding on a source of finance for the new vehicles. Again, we discussed sources of finance in detail, and I also mentioned that it depends heavily on not only the type of business, but the type of purchase or the reason they're going to raise the sources of finance. This is paper one, October, November 2025. So in this case, they are getting new vehicles. And as we read above, CPW is a private sector business which has a lot of objectives. And it has like 36 shops in in Country X, which shows us that it's like a well-standing company, and it's not a very small business, right? And it buys all its inventory from local suppliers, from tariffs, da 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 da. Right, okay, so 10 new vehicles. Can you say yes to test ratios of the application? Oh, what do you mean? Can you elaborate? I'm sorry. Warsif. The 6 markers again. Yeah, just getting to it. Question E or question D? Do you know the test ratios that which I still don't understand what this question means. I'm really sorry. Yeah, getting to it. I'm gonna explain both questions again, and this is gonna be the last two questions I'm gonna explain. Question C. Oh, right. So in this case, we're just gonna put like one knowledge point and one application on how it's gonna be useful specifically to CPW. So, isn't the answer about size and legal structure? In what question, Flicky? CPW should look at the rates of interest. Rate of interest of source of finance when deciding them. Yes, CPW should consider the rate of interest. Because again, if they buy 10 cars for, I'm just throwing out numbers here, $50,000, and if the interest rate on the loan they get for that said $50,000 is like $40,000, that's gonna be like really detrimental for them to pay off, since it does more harm than good. A good interest rate is anything below $20, but it also depends on the kind of loan. So $20 interest on a very small loan is going to be bad, but if it's like huge amount of numbers, 20% is fine, I think. Time period and amount for what question? The trickiest question, please. Which one is the trickiest question? I'm not sure what you mean. Okay, question D. I was explaining question D. I guess this, as I was saying, so two factors are what they should consider is that they're getting cars, right? So cars are a sort of non-current assets since they're going to be used more than a year. So in this way, I think loans are a good way if they want to buy the cars immediately. However, they could also lease out the cars or use the cars on a hire purchase, not lease out, my bad. Hire purchase is also a good way to gain cars since they don't gotta pay like the total amount of 10 cars at once. Instead, they gotta pay a percentage of the amount for each car. However, it may be a little more expensive than paying in bulk, but it saves them short term on the cost of 10 cars. Loan factor. Loan is not a factor. You need to write factors such as time, the time and the size of the business. So the way the time is going to be used is that how quick do they want the cars? If it's very urgent, they can go for hire purchase, or they could go for what do you call it? They could go for loans because if they want it urgently, they want a short-term source of finance that they can get immediately and then pay off. However, if they want to, not buy it immediately, they should, go for something that's more long-term sustainable, such as, hire purchase or Kickstarters, etc., etc. And factor two can be what's called this. Let me think. Let's just check the marks because I'm sort of blanking out. Yeah, time period is there. And yes, amount required. Oh my god, how did I miss this? So for 10 vehicles, you need to consider how much 10 vehicles itself would cost because it's not going to be cheap. So if you get like large loans or selling like your non-current assets you have, such as other machinery, in order to pay for your, what do you call it, the cars in question. So depending on how much money you need for it, you may or may not need to, take on more demanding sources of finance, right? Make sense? Okay, good. Question E, this is going to be the last question I'm going to be solving with you guys. Explain two objectives a private sector business might have. Which objective is more likely to be the most important? Justify your answer. Now, business objectives are a really important part of a company since business objectives tell a company what they want to do, right? So, two objectives, like objectives a private company can have is one, they're gonna be like, if they're a small company especially, they're gonna be in a more survivalist mode. That means just barely trying to meet all of their costs and in like all the expenses, costs, and just surviving above the line. Private companies can also have what's called as an expansion or growth motive. They can also have a profit motive and just in general a lot of other motives. So with a CPW, we see that they're a well-established business in their industry because they have like 36 outlets. So we assume that they're not in, a survival period. Instead, they're going to be focusing on expansion and profit. So first, we're going to write about how private sector business CPW would have a profit motive because they're not in survival mode, and so they'll be focusing on profit since it leads to more growth, more what do you call it, more amount that can be reinvested into a business, and therefore they're going to be working on maximizing how many they own. Also, it's a good way to write some definition if you don't really have what do you call it, an analysis point. So how we see in the mark scheme, you make a profit when revenue exceeds total costs. It's not really an what do you call it? It's not really an analysis, but it's a definition which they have considered an analysis. So do keep that in mind. So one objective is profit incentives, since it means that retained earnings are increased. And so when retained earnings are increased, give me a second, guys. Yes, I'm getting to the evaluation in 2 minutes. Give me a second. Okay. Once you have your general business, CPW is given in the tiny case study, so we do need to follow them and use specific application points. But what are we talking about here? Yes, laudanum, your answer is perfect. Because firstly, private sector should focus on profit since it leads to more growth of the business. You can also add like another sentence just to be safe here, since it leads to more growth of the profit of the business by, you know, increasing the amount that can be reinvested. Secondly, a business should focus on survivability. However, as I said before, it's not really specific to CPW, because again, we see that they're not in a survival state, they're a well-established business. So I would personally go for a more expansion-oriented approach, since again, they mentioned they have like 36 outlets in the country, so they might want more. So having more outlets allows them to get their products out to more people, hence increasing sales and thus revenue. So in conclusion, a business should focus on profit as it helps business cover liabilities more easily. This is a perfect conclusion, right? Good job. Any questions? I'm sorry if I'm rambling a lot right now. I'm not covering Unit 5 because, again, I'm not very good with math, so it's just more of a risk if I teach you that. You're better off learning from YouTube. Any other questions, or do you want me to go over, aside from the calculations, chapter 1, 2, or anything else? Or do you guys want to call it a night? Marketing, yes, okay. Chapter 8 and 9. I don't see chapter 9 here. Wait, let me check. Not seeing operations management. Yeah, okay, we can go over operations management. Let me see what chapter 9 was. Also, I hope you guys aren't bored. There's no chapter 9. Okay, so we're gonna do marketing first. Recruitment chapter and communication. Yeah, okay, we'll get to that. Also, in case we're not able to do everything tonight, there's this really good guy. He does make videos for AS and AL, but a lot of the topics like operations management are pretty similar to what you guys are doing. So I'm gonna link the channel as well so you guys can check it out. Taking the biz, I think. yeah, do check out his videos. They're pretty helpful, even if you guys are in O levels. There's a lot of topics that he covers. In case we don't complete everything tonight, but I'm trying to. Okay, so don't worry, sorry. Okay, speedrunning this. What is marketing? Marketing, by definition, is the management and process responsible for, satisfying consumers' requirements while, getting your product out there. So the role in of marketing in a business is identifying consumer needs, satisfying consumer needs, and maintaining customer loyalty. And marketing also deals with gaining information on employee and customers, my bad, such as what do customers want, what's the leading demand. And also they anticipate changes in customer needs, such as trends changing, instigating new trends and stuff. Like, I think you get the point. Yeah, I'm sorry. Also, I don't know why it's not mentioned here, but marketing mainly also works with getting the product and making customers aware that the product exists or why the product stands out in regards to other businesses. So marketing is pretty important. So marketing changes. Why market changes, my bad. Why customers' spending patterns may change. So change in tastes and preferences, such as, one day matcha may be the main process responsible for, satisfying consumers' requirements while, getting your product out there. So the role in of marketing in a business is identifying consumer needs, satisfying consumer needs, and maintaining customer loyalty. And marketing also deals with gaining information on employee and customers, my bad, such as what do customers want, what's the leading demand. And also they anticipate changes in customer needs, such as trends changing, instigating new trends and stuff. Like, I think you get the point. Yeah, I'm sorry. Also, I don't know why it's not mentioned here, but marketing mainly also works with getting the product and making customers aware that the product exists or why the product stands out in regards to other businesses. So marketing is pretty important. So marketing changes. Why market changes, my bad. Why customers' spending patterns may change. So change in tastes and preferences, such as, one day matcha may be the most trending coffee, the second some new influencer comes out and all of a sudden cappuccino is on the new hype. Changes in technology, such as, your old laptop, no one's gonna use the same laptop more than 5-6 years because new models come out, and so people like to upgrade. Tastes changes in income because the higher the income, the more luxury and expensive goods the consumers will buy, and vice versa. As I discussed, during periods of inflation and recession, income will decrease, and so consumers are less likely to spend on products that do not fill their needs and are instead like more entertainment oriented. And aging population in countries, a lot of like the population is really old people. So if your age population is like really old people, your cinemas, your arcades and stuff, they're not going to work a lot. And instead you need to cater to the age population, such as, I don't know, Monopoly or Bingo game hosts and stuff. So basically, yeah, demographics are important. The power and importance of changing customer needs, because firms need to know what the consumers want. So in order to stay ahead of competitors and stay profitable, if they don't, cater to consumer demands, they're gonna, fall short of the demand. Why markets have become more competitive is because globalization, which refers to products and companies selling products in more different countries, which allows for more variety, and so consumers have more of a choice compared to olden times where there was like one, two ruling monopolies and consumers didn't have much of a choice. Then you have improvement in transportation, and again ties to globalization, that products that were previously very restricted to a certain area are now able to reach different parts and regions in the world. And then you have e-commerce or the internet, that online shopping is made more readily available, so they can buy anything from anywhere throughout the world by just like sitting down in the comfort of their own home, right? Businesses, how can they respond to changing patterns? They can maintain good relationship with their customers, ensuring that customers stay loyal to the business. They can improve their existing products, how Samsung creates updates in their phones every now and then. They can introduce new products, like new models of phones going out, like you have your S23, 24, 25, etc. So customers keep buying that, and you keep your costs low, so consumers feel like you're the best and cheapest alternative they have compared to other sorts of firms. Then you have your niche and mass marketing. I'm going to run this over. Niche marketing is basically identifying a small, very, like, by definition, niche segment of a market. So, for example, this is done by a lot of luxury brands, and oftentimes they're like very self-created problems and a self-created solution. And this can also be done for specific brands of professions. So, for example, specialized art supplies, textured acrylic. There's not like a mass market for this stuff, but the market exists, and sometimes these products are priced like almost outrageously, but the people who do engage with the market do buy them at said outrageous prices. So it's important to note. Small firms are often like thriving in niche markets because big firms usually try orient themselves to mass markets, which just refers to having like a more generalized audience compared to like a small specialized audience. I'm saying audience for some reason, customer base. And so the reason small firms are able to thrive in niche markets is because they can focus on like selective needs and what to make a very specific set of products better, instead of trying to play an all rounder and do so much at the same time. Yep, there's a lot of exploitation in niche markets because there's not a lot of competitors, so businesses feel like they can charge whatever and customers oblige. There are a few limitations of niche markets because there's a lack of economies of scale. It's like a concept that the more you produce, the more your average costs fall. There's a risk of overdependence on a single product, because if the demand for the product falls, a firm won't have like a fallback market or some backup. So this would lead to them falling in debt or failing, and they're also more likely to attract competition into said niche market if they're like very successful. Mass marketing is the opposite of niche marketing. It's basically selling the same product to a large market with no attempt to really segment the market, such as the iPhone being sold everywhere, even though there's no variations in design, location, income. Everyone is just expected to buy it. And the advantages are that large firms are able to get like large amount of sales compared to niche markets, which increases their revenue. They can benefit from a lot of economies of scale since they're producing a large volume of the same product. Risks are spread, so unlike in a niche market, if the product isn't successful in one market, like one demographic, if the iPhone doesn't work in Dubai, it can still work in the US, and vice versa. More chances for the business to grow since there's a large market. They're gonna get like more customers buying the product, and in turn, they're more likely to create a reputable brand image. Yes, this is also a thing that costs in niche markets are high because, again, it's specialized service, and the lack of economies of scale makes it much more expensive to produce the same products. Anyways, mass marketing limitations, they have to face a lot more competition. There's like a chance of giant monopolies making barriers to entry really high, and they can't charge a very high price because again, there's a lot of competition, and as we've read in the free market thing, that everyone's competing against each other to cost cut and give the same product at the lowest possible price to gain the most customers. So it might not be too profitable in the short term. You have your market segmentation, which is basically dividing the market into different demographics based on your socioeconomic groups, age, location, gender, lifestyle, etc., etc. So this is generally marketing catered towards men's clothes versus women's clothes. School stationaries are, aimed towards kids in schools. Toys are segmented between age groups such as kids' toys, tween toys, and then you have like the more specialized toys such as minifigures, Legos that are targeted towards a more teenage audience. This is just like a couple examples of how markets are segmented. So, what do you call it? The marketing that is done is more effective towards each demographic as compared to just like a general advertisement for everyone. Advantages are makes marketing cost effective as it only targets specific segments, allows high sales profitability, more customer loyalty, increased opportunities to increase sales. And disadvantages, how would be they're missing out on, a few other customers who would be in other demographics, and the cost would rise because, especially for a firm that operates in different demographics, such as a clothing brand such as Centerpoint, which deals in both children's clothes, adult men, adult women, etc. So they'd have to make like separate ads for each demographic, which would increase costs. Any questions? Or any other topic? I know I'm speed running, but yeah, it's late. Globalization chapter after this. Can you tell me what chapter it was in? Market segmentation. As I just said, market segmentation is basically to be able to market your product more efficiently to a specified group, to cater to their needs better, instead of just throwing out advertisements to everyone and hoping for the best. So not really. Market segmentation is more broad than niche marketing, because niche marketing is like narrowing out a very, very specific sort of couple few people. However, market segmentation is just like dividing people based on very broad characteristics such as gender and how a clothing store needs to make different ads for women's clothes and men's clothes. Business and international production. Let's go over production, since I feel like it's an important chapter, but I'm going to be ending stream soon, or at least take a break of 5 minutes because my throat's going to die. Let me just pull up the chapter. Okay, yeah, production of goods and services. Okay, so production is basically how much of something you can produce, right? So there's a couple ways you can produce, but basically it's measured in terms of productivity. So the basic formula for it is productivity is equal to quantity of output versus over the quantity of input. So the more output you have based on how much input you have is like how efficient your firm is. Labor productivity refers to the number of output over a given time period over the number of employees you have, right? So these are like two important formula you need to remember. So businesses try to increase productivity and efficiency, and so the average cost of production will fail because, again, economies of scale is pretty important to businesses, especially large businesses. So you have inventory management. Firms can hold inventory or stock of raw materials that are not completed yet, like a work in progress, raw materials, etc., and finished unsold goods, right? Goods that have been done but just waiting to be shipped out to be sold. You have your types of production, which is lean production, which is various techniques a firm can adopt to reduce wastage because they're literally trying to be lean. So some types of wastage are overproduction, producing goods before they have been ordered, and in the end, they don't end up selling and just wasting, resulting in spoilage costs, high inventory holding. Then you have waiting, because when goods are not being moved or sold, they're just sitting and rotting in your warehouses, again, leading to high storage costs. You have transportation. When you move goods around too much, you cost drivers, petrol, etc., etc. And you have unnecessary inventory. Again, unnecessary inventory takes up more inventory costs. You have motion, unnecessary moving of employees, operation machinery. It's just a lot of work, not enough, gain from it. And you have over processing, which is essentially just like using too complicated methods of producing what's like simple stuff. So for example, I send my eggs to pre-bake before I crack them to make a cake. That's just like over processing and lame. And then you have defects or kerfluffles, which are essentially defects in the products. And so a fault in equipment can also halt production and waste time, but also when goods are faulty or they have like some manufacturing kerfluffles in them, it results in, the goods not being able to get sold. And instead it costs the business, the cost of producing the goods. However, they can't, earn back the lost cost on those goods, right? By avoiding wastage, the firm is going to have like less costs in general. I'm not going to be going over Kaizen because it's pretty lame. I have never seen them in any past papers. You have just-in-time inventory control, and you have self-production. So just-in-time inventory current control means producing each unit that is needed just as it's ordered, right? So I'm not going to be unnecessarily producing I'm not going to be unnecessarily producing units of good. I'm just going to be producing them based on like just enough of the amount I need and just before I need to sell them. Okay, so I don't have like unnecessary holding or storage costs. Just like as soon as I produce it, it can be shipped out. Self-production is basically when production line is divided into it's basically just like breaking down production into simpler steps, so new employees, when you hire them, don't feel very overworked, and it's easier to teach them, right? You have your other methods of production, which I already went through past papers like a while ago. So methods of production, you have job production, when products are specifically made to order or like customized for each customer. So for example, wedding cakes, tailored dresses, like tailored suits, etc. And they're like more sustainable for one-off or highly specialized production. However, you need very highly skilled labor and flexible methods of production. And this is generally really expensive to maintain, especially for a new business, and production takes a really long time. And there's no economies of scale. Then you have batch production, which is similar to job production, but instead of one piece of output per production cycle, you have like 10, 12 being created per each batch, right? So this is usually used in clay businesses, jewelry, oftentimes in clothing brands, as well as bakery, restaurants, etc. Like you bake everything in batches of 10, 12, etc. And this gives variety to workers. This also lets like it keeps the flow moving. So if one product's machinery breaks down, other products can still be made. However, this also again can be expensive. There's a lack of economies of scale. Raw materials will be needed again and again for different batches, and there can be inconsistencies within each batch. So quality control is difficult. You have flow production, which is large quantities of products that are produced in a continuous like production line, similar to cell production. There's like a standardized output of identical products. So costs are low in the long run, since again economies of scale, prices can be kept low, and most automated production lines can run 24/7. Products are quickly and cheaply produced. Capital intensive, so less labor costs. However, it's a very boring system for workers. They feel redundant. There's no job satisfaction. Raw materials and finished goods need to be held in inventory, so this is expensive. Capital cost is very high, and if one machinery breaks down, the entire production will be halted. So there's a lot of factors which affect what just-in-time production, other than delays. With just-in-time production, you have like a higher opportunity cost, because sometimes you get offers of like really large quantity of orders, and so I'm fine, I'm not dehydrated. So where was I? So yeah, if they do get a large order and they can't fulfill it in time, they have no leftover stock to, fulfill the order. So they need to often forfeit large opportunities that may have been beneficial for the business if they did take up the offer. Makes sense? Also, another thing is that for just-in-time production, just-in-time producers often order the supplies as they need it. So in case the supplier creates a delay, the whole production line will essentially be affected by the delay made by the supplier. Next we have technology in production. I'm gonna sort of low-key kill myself if I sit through another past paper. But this session will be recorded and posted onto YouTube, so you can go through it again. Pretty basic stuff, honestly. So we have technology in production. So we have automation, pretty self-explanatory, which is equipment or capital-intensive equipment used in factories controlled by computers to carry out mechanical processes such as spray painting cars, etc., etc. You have whatever the word is, I don't want to read it right now. Production, which is done by machines, but the machines are operated by people. So, in the films you see the things where, humans are sitting behind levers and the machines are doing this stuff. Or, you could even use the example of forklifts, since they're a sort of mechanics, whatever. Then you have computer-aided designing, which is a software that draws items being designed more quickly, allowing them to, be viewed in 3D, rotated, zoomed in, etc. You have computer-aided manufacturing, which computers monitor the production, similar to robots, automation, and AI in this context. You have computer-integrated manufacturing, which is like the mix of CAD and CAM, so computers design the product and then it's connected to, manufacturing by the computer. Then you have electronic point of sale, which is often used at checkouts and tills, where, the self-checkout bars where you do it yourself, and each item is bought by the customer individually, and so details and stuff appear on the barcode as you scan it, so you don't need to individually log everything physically in like a notebook or something. And then you have electronic funds transfer at point of sale, so basically your credit card, debit card, etc. Advantages of technology is that greater productivity, greater efficiency, job satisfaction among workers, as boring routine jobs are done by machines, so they don't feel bored. They have like better quality products. There's quick communication, less paperwork, and there's more accurate information and data that's being overseen by the computers, and new products can be introduced quickly. Disadvantages are unemployment, expensive setups, technology is prone to becoming outdated, so frequent updates of systems, you need a lot of maintenance, and so employees may be hesitant or take time to adjust to new technology, and some might even resist, such as, the debate with AI. People are saying that, it's replacing jobs, and that's like a big ethical issue these days. So you can use that example as well. Make sense? Let me know if I should continue. These aren't important on their own. There's no short questions, but they can be used in your 6-mark questions. Okay, what else? This is CIEs, yes. International economy. Okay, international economy. Types of economies of scale. Everyone's telling me different topics, just decide one. And I think that's where we're going to end today. The YouTube link I sent you is really helpful for more topics in case I miss anything. Okay, so is everyone fine with international economy? Okay, so international economy, I hate this chapter. Okay, so globalization, as I discussed before, is a term used to describe when businesses start selling their products outside of the global market, which means internationally within different companies or cities, etc. And so this is aided by the increasing number of free trade agreements. So import, export have less tariffs, improved and cheaper transport, so airplanes or ships, etc., which make transport faster and cheaper. And then you have developing and emerging countries such as China, India, etc., which are becoming so rapidly industrialized so that they can produce and export large amounts of goods and services, and increasing output and opportunities in international trade, right? To sell in new foreign markets, they can open factories and production units in other countries and run at a cheaper rate, such as how people open up firms in countries such as China, Nigeria, India, Pakistan, because the labor here is very cheap. And you can import products from other countries, such as, raw materials and stuff that's not readily available in your country that you use in your production. And you can import other products from other countries and sell it to customers in the domestic markets as a retailer or as a tertiary sector business, right? Then you have disadvantages of globalization. It's that increasing imports into the country from foreign competitors, and so foreign firms now compete in your country, and this puts more competition for domestic firms. And if these domestic firms, especially small firms, cannot really keep up with these large international firms, they may be forced to shut down operations. Increasing investment by multinationals in home country could add to competition in the domestic market, since again, small businesses aren't really strong. However, oftentimes this can be beneficial beneficial to small firms, since especially if they're producing raw materials at a much cheaper price. Large firms or international firms are gonna prefer sourcing the materials from the country they're residing or producing in. Employers may leave domestic firms due to, the promise of better pay outside, which is, the reason why people leave their hometown, especially immigration in countries, again, in a lot of Asian countries, most people head to the Middle East or to the USA, Australia, Britain to get, better pay, better salary packages, and this in turn could leave the domestic firms back at home to, struggle with finding competent labor. Just a question. I could do session on next Monday, but I'm gonna need to check if I have my exam as well, because I don't want to risk messing over computer science. Is it on the 18th? Oh yeah, I'm gonna try do a session then. Just do let me know 2 days ago, if possible, so I can prepare accordingly. Okay, back to the topic. Where were we? Okay, yeah. Protectionism is essentially when governments work to protect their domestic firms from foreign competition, because, as I said, multinational and international companies are, a lot stronger than your local small firms. So the ways governments safeguard domestic firms is like import quotas, so restriction on the quantity of goods that can be imported to, essentially motivate or give an incentive to local firms to produce. You have tariffs, which are taxes on imports, which can be, used to discourage the use of imports and again motivate people in the country to produce. And these two measures reduce the number of foreign goods in the domestic market and make them too expensive to buy, so normal people will opt for more domestic products, right? Then you have your multinational companies, which are firms with operations in more than one country, such as McDonald's, Ferrari, other giant companies, right? And why firms become multinational is, one, to produce goods with lower costs. So they see and scout out the cheapest company to manufacture in, and then they try to maximize the market they sell in. So, I produce in a country such as India, where labor is the cheapest, resources are the cheapest, and then I export my products into, different countries such as the USA, Britain, Canada, etc. They also need some materials which aren't available in their country, but they're very cheap somewhere else. So, for example, oil in the Middle East. You have to produce goods near to the market. So, for example, McDonald's has franchises near to each, what do you call them? Like in malls and stuff, they don't have a firm in one place. They need to be near to them consumer base. They also avoid trade barriers on imports, because if they produce goods in the foreign countries, the firms will not have to pay import tariffs or be put with quota restrictions. And also just to, maximize profit. Advantages to country with a multinational setting is like more jobs, increased GDP, more technology, new ideas, more goods, and, in being produced in the country, so imports are reduced. And also multinationals pay a large amount of taxes, and they increase the government's tax revenue, and ultimately more product choice for customers. And this also provides a healthy competition in most cases to domestic firms to, compete better and better themselves. However, disadvantages would be jobs are created for unskilled tasks, so the more skilled jobs will be done by workers that come from the firm's home country. So the unskilled workers, such as manual laborers, will be exploited with low wages, unhygienic conditions, etc. Local firms may be forced out the business. Again, explained this a few times. Multinational can use up like a lot of resources in the country, which can in the end create resource scarcity in the country. And you have profits and by multinationals could be sent back to their home country, and the government cannot tax them, even though they're sort of like profiting off the country itself. They're not giving much back to it, which can, in the end cost the country. And then you have like multinationals which are way too large and they influence government decisions, economies, and they could threaten that the government, they will close down and make a lot of workers unemployed. So for example, if your local McDonald's chains close, you can imagine how many people are going to be jobless because, again, so many people are employed there. I'm not going to be going over exchange rates because I don't want to. Do you want me to go over exchange rates? Or do we end today here? Okay, we're going to go over exchange rates. Yay. Exchange rate is pretty simple. It's due to the difference between each country's economy. So $1, $1 is not equal to one dirham. There's a lot of inconsistencies. So you got to know how to convert each currency into, the currency you're buying in or the currency you're selling in. So it's easier to, understand the exchange rates. And a currency appreciates when its value rises. This just means that a European what am I saying? And a European firm exporting will, find appreciation disadvantage as, American consumers will have to pay more to buy, the same good. So exports become expensive. However, the opposite would be that imports become cheaper if the buying currency is stronger than selling currency. Then you have your basic thing about like competition. So each firm tries to, have it, like not firm, but each country tries to keep its, what do you call it? God, each country tries to keep its currency high. So in the end, it's better competition since everyone tries to, get their currency high by increasing GDP, strengthening the economy. So exports are more likely to be on an equal basis instead of like very unbalanced, and this leads to healthy competition among economies. And so in turn, firms can benefit off of this with like cheap imports in each currency there, like especially for multinationals. They try to, import in like the strongest currency and export in the weakest currency to, get the most profits that they can. And so I will be ending the session here for now. If I had known earlier, I would have like broken this into 2 different sessions. But thank you all for sticking around and listening. Good luck with your exams. And if you have any questions, just feel free to drop me a DM. I'm going to respond on chat. My throat is dead. And I hope everything was explained really well. Thank you.